In September 2008, $2 trillion of wealth vanished from the American economy in just 18 days. Not stolen, not taxed away, just gone. Evaporated like it never existed. But here's what nobody told you. That money was never real in the first place. It was a ghost, an accounting trick, a number on a screen backed by nothing but confidence. And when that confidence broke, so did everything else. This is the anatomy of a credit crisis. And the pattern that created it? It's happening again right now. Let's go back to 2003. The economy is recovering from the dot-com crash. Interest rates are at historic lows. The Federal Reserve dropped them to 1% to stimulate growth. If you wanted to borrow money, it had never been cheaper. Here's what people believed. Housing prices always go up. Always. It was treated as a law of physics, not an economic trend. If you bought a house, you were making a safe investment. If you lent someone money to buy a house, you are making a safe loan. This is where the financial institutions enter the story. Banks like Countrywide, Washington Mutual, and Bear Stearns weren't just making loans anymore, they were manufacturing products. They'd bundle thousands of mortgages together, slice them into pieces called mortgage-backed securities, and sell them to investors worldwide. Here's how the mechanism worked. You take out a mortgage. Your bank doesn't keep that loan. Instead, they sell it to an investment bank. That investment bank combines your mortgage with thousands of others, then sells shares of that giant pool to investors. Everyone makes money at every step. The mortgage broker gets a commission. The bank gets a fee. The investment bank gets a fee. The ratings agencies companies like Moody's and S&P that grade how risky these investments are, they get paid too. You see the problem yet? Nobody in this chain actually cares if you can pay back your loan. They've already been paid. They've already passed the risk to someone else. By 2005, the warning signs were multiplying. Mortgage fraud was rampant. People were claiming six-figure incomes without providing any proof. These were called liar loans. Others were getting ninja loans, no income, no job, no assets, no problem. One mortgage broker later admitted, "We'd get applications from strawberry pickers claiming $120,000 annual income. We knew it was fake. We didn't care. But there was one belief that papered over every warning sign. Housing prices always go up. As long as that was true, none of this mattered." In early 2006, something changed. Housing prices stopped rising. In some markets, they actually started falling. Most people didn't notice. Those who did assumed it was temporary, a healthy correction, a pause before the next surge. But here's what was happening beneath the surface. Those mortgages that seemed safe, they were ticking time bombs. Many of them were adjustable rate mortgages ARMs. Borrowers got ultra-low teaser rates for the first 2 or 3 years. Then the rates would reset to much higher levels. When housing prices were rising, this wasn't a problem. If you couldn't afford the new payment, you just refinance or sell the house for a profit. But when prices stopped rising, that escape hatch disappeared. In late 2006, foreclosures started climbing. Subprime lenders companies that specialized in risky loans to people with bad credit started failing. A company called Own It Mortgage Solutions collapsed. Then Renaissance Home Equity. Then Mortgage Lenders Network USA. Most people had never heard of these companies. Mainstream media barely covered it. These were small players, right? The big banks were fine. They weren't fine. By early 2007, the problem had metastasized from subprime mortgages to the entire financial system. Remember those mortgage-backed securities? They were everywhere. Pension funds owned them. European banks owned them. Hedge funds had borrowed billions to buy them. Here's where it gets technical. But stay with me, because this is the key. Wall Street had invented something called a CDOA, collateralized debt obligation. Essentially, they took the riskiest slices of those mortgage-backed securities, bundled those together, and created a new product. They were repackaging toxic waste and calling it gold. Rating agencies gave these products A ratings, the same rating as U.S. Treasury bonds. Even crazier, they created synthetic CDOs, financial bets on whether the original CDOs would fail. It was like selling insurance on a house that was already on fire, then selling insurance on that insurance. In February 2007, HSBC announced larger than expected losses in its U.S. mortgage business. In April, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. The warnings multiplied. Analyst reports started using phrases like elevated risk and potential contagion. A few hedge funds that specialized in these securities started showing losses. One fund manager, quoted anonymously later, said, "We knew the math didn't work. We just thought we'd get out before everyone else did." They didn't. Then came June 2007. Two hedge funds run by Bear Stearns, one of Wall Street's most prestigious firms, collapsed. They'd borrowed massive amounts of money to bet on mortgage-backed securities. When those securities started losing value, their lenders demanded their money back. The funds couldn't pay. Bear Stearns tried to contain it. They pumped $3.2 billion into one of the funds to stop the bleeding. It didn't work. By July, both funds were worthless. This was the moment the smart money got scared. If Bear Stearns, a firm that had survived the Great Depression, that had weathered every crisis for 85 years, if why we're in trouble, who else was exposed? In August 2007, the credit markets froze. Banks stopped lending to each other. Why? Because nobody knew who was holding toxic assets anymore. These mortgage-backed securities and CDOs were so complex, so widely distributed, that every major financial institution was potentially contaminated. The interest rate that banks charge each other, called LIBO, are suddenly spiked. This was unprecedented. Banks were so afraid of each other's solvency that they'd rather hoard cash than make profitable loans. The Federal Reserve noticed. In September 2007, they cut interest rates for the first time in 4 years. The stock market celebrated briefly. Problem solved, right? Wrong. What happened next shocked everyone, even the experts. The Federal Reserve kept cutting rates. Once in September, again in October, again in December. By January 2008, they'd slashed rates by an entire percentage point in just 4 months. This was the central bank's emergency signal. We have a serious problem. Major banks started announcing losses. Citigroup, $18 billion write-down. Merrill Lynch, $8 billion. Morgan Stanley, $9.4 billion. These weren't small regional banks. These were titans of American finance. Combined losses by early 2008 exceeded $100 billion. In March 2008, Bear Stearns ran out of money. Completely. The fifth largest investment bank in America, a firm with $395 billion in assets, was about to collapse in a matter of hours. The Federal Reserve orchestrated an emergency sale to J.P. Morgan Chase for $2 per share. Just a year earlier, Bear Stearns stock had traded at $133 per share. At this moment, even the experts realized there was no stopping this anymore. The question wasn't if the system would break. It was and how bad it would get. September 2008 became the month that changed everything. What started in subprime mortgages suddenly exploded into every corner of the financial system. Fannie Mae and Freddie Mac, government-sponsored enterprises that backed nearly half of all U.S. mortgages, were on the brink of failure. On September 7th, the U.S. government seized them both in the largest bailout in American history up to that point. 1 week later, Lehman Brothers collapsed. September 15, 2008, Lehman Brothers, 158 years old, $639 billion in assets, filed for bankruptcy. It remains the largest bankruptcy in U.S. history. Unlike Bear Stearns, there was no rescue. The government let them fail. The same day Lehman collapsed, Bank of America announced it was buying Merrill Lynch in an emergency fire sale to prevent another failure. AIG, American International Group, one of the world's largest insurance companies, was hemorrhaging cash. Why was an insurance company in trouble? Because AIG had sold credit default swaps, essentially insurance policies on those toxic mortgage securities. They'd promised to pay out if the securities failed. Now everything was failing at once, and AIG owed more money than it had. On September 16th, the Federal Reserve gave IG an $85 billion emergency loan. It wasn't enough. Eventually, the government would pump $182 billion into AIG to keep it alive. On September 29th, the stock market experienced its largest single-day point drop in history. The Dow Jones fell 777 points. The S&P 500 dropped 8.8%. In the trading pits, veteran traders said they'd never seen panic like this. For ordinary people, this meant everything. Your 401k lost 30%, 40%, sometimes 50% of its value in weeks. Your neighbor lost their house. Your brother-in-law lost his job. Entire neighborhoods became ghost towns, rows of foreclosed homes with overgrown lawns and broken windows. Unemployment climbed from 5% to 10%. 8 million Americans lost their jobs. The total household wealth destruction? By some estimates, $16 trillion. But the truly insidious part? The people who created this crisis, the executives at the banks, the mortgage brokers who pushed fraudulent loans, the ratings agencies that stamped AA on garbage, most of them walked away wealthy. In October 2008, Congress passed the Troubled Asset Relief Program, TARP, a $700 billion bailout of the financial system. The message from Treasury Secretary Henry Paulson was clear. If we don't do this, the entire financial system collapses. ATMs stop working. Companies can't make payroll. The economy enters a death spiral. The public was furious. Why should taxpayers bail out the banks that caused this? But the alternative, a complete systemic collapse, was worse. Final cost to the U.S. economy: $2 trillion in lost wealth. September 2008 became the symbol of this collapse. The moment when confidence in the financial system completely evaporated. The moment when everyone realized that the experts didn't know what they were doing, that the system wasn't safe, that the rules didn't protect us. By early 2009, authorities had taken drastic action. The Federal Reserve dropped interest rates to effectively zero. They'd run out of conventional ammunition. They started quantitative easing, essentially printing money to buy government bonds and mortgage securities. The government injected capital directly into banks. The fiscal stimulus followed $787 billion in government spending on infrastructure, tax cuts, unemployment benefits. The idea was simple. If the private sector won't spend, the government must. It worked, barely. The economy stabilized in mid-2009, but the recovery was agonizingly slow. It took until 2014 for employment to return to pre-crisis levels. It took even longer for many families to rebuild their wealth. What many people don't realize is how the crisis transformed American society. Trust in institutions collapsed. The gap between Wall Street and Main Street became a chasm. Political polarization intensified. The Tea Party movement on the right, Occupy Wall Street on the left, both fueled by rage at the bailouts. Home ownership rates fell. An entire generation of young people graduated into the worst job market since the Great Depression. They delayed buying homes, getting married, having children. The psychological scars lasted years. And here's the most disturbing part. Many of the structural problems that caused the crisis weren't fixed. Banks became larger through consolidation. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America absorbed Merrill Lynch and Countrywide. The phrase "too big to fail" became even more true. The Dodd-Frank Act passed in 2010, creating new regulations and oversight. But over the following decade, many of those provisions were watered down or eliminated. 10 million families lost their homes to foreclosure. This collapse followed the exact same arc as every major financial crisis in history: the 1929 stock market crash, the savings and loan crisis of the 1980s, the dot-com bubble, even the tulip mania of 1637. Every financial crisis has the same DNA. First, there's a new paradigm, a belief that this time is different. In 2008, because housing prices always go up. Second, cheap credit floods the system. Leverage increases. Risk gets mispriced because money is easy. Third, warning signs appear. Experts sound alarms. They're ignored or dismissed as pessimists. Fourth, the crisis accelerates faster than anyone expected. What seemed stable on Tuesday is bankrupt by Friday. Fifth, panic takes over. Everyone rushes for the exits at once, and the exits aren't big enough. Sixth, the system freezes. Credit disappears. Confidence evaporates. The economic machine seizes up. Understanding the 2008 crisis teaches us that financial systems are built on confidence, not concrete. When people believe the system works, it works. When they stop believing, it collapses, regardless of the underlying fundamentals. It teaches us that complexity is the enemy of safety. The more complicated the financial products, the easier it is to hide risk until it explodes. Most importantly, it teaches us that the pattern repeats. Not identically, but rhythmically. Different assets, different mechanisms, same structure. The 2008 financial crisis taught us to look for specific warning signs. Excessive leverage, complex financial products that nobody fully understands, belief in a new paradigm that defies historical patterns, and a disconnect between asset prices and underlying fundamentals. Today, those warning signs are appearing again. First warning sign: debt levels. Total U.S. debt, government, corporate, and household combined, is higher now than in 2008, both in absolute terms and as a percentage of GDP. Corporate debt has exploded, with many companies borrowing cheaply to buy back their own stock rather than invest in productive assets. Second warning sign: complex financial instruments. The modern equivalents of CDOs are everywhere: leveraged loans, CLOs, collateralized loan obligations, private equity structures with multiple layers of debt. Sound familiar? Third warning sign: asset price disconnections. Commercial real estate is showing cracks. Office buildings in major cities are half empty, valued at pandemic prices that no longer reflect reality. Parts of the stock market trade at valuations that only make sense if corporate profits grow forever. Is this pattern repeating? We can't know for certain. The timing is unpredictable. Markets can stay irrational longer than you can stay solvent, as the saying goes. But the structure is eerily similar. The mechanism might be different. It might not be mortgages this time. It could be corporate debt, sovereign debt, or something we haven't identified yet. But the pattern of excessive leverage plus complex products plus misplaced confidence, that pattern is visible right now. History suggests we should be paying very close attention. The Federal Reserve raised rates aggressively in 2022 and 2023 to combat inflation. Now they're cutting again. Sound familiar? When interest rates change rapidly, things break. We saw it with Silicon Valley Bank in 2023. We saw it with several regional banks that failed. These might be isolated incidents, or they might be the early tremors before a larger quake. The 2008 financial crisis proved that money is confidence, debt is leverage, and complexity is danger. And when all three converge, systems that seem permanent can evaporate overnight. The question is not, will this happen again? But are we prepared if it does? The patterns are there. The mechanisms are similar. The confidence might be just as misplaced. What do you think are the warning signs we're missing right now? Are we headed for another crisis, or is it actually different this time? Drop your thoughts in the comments below. I read every single one. If you want to understand how these patterns play out in different contexts. Next, we'll explore how hyperinflation destroyed Venezuela's economy, a different type of financial crisis with the same underlying structure. Thanks for watching. Stay informed, stay skeptical, and I'll see you in the next one.